Oh, hi guys. Now if you've watched my iceberg video by now, you've jumped in the water as a newbie trader and you found it's very cold and very deep. So what do you do now? Well, the first thing you need to do is to understand what makes the price move. And I'm going to try and explain that as simply as I can in this video. How why price moves and how the bank guys paint the charts. Now, anybody who's done any scientific style mathematical modeling on price action will tell you that price action is a random walk with levy flight characteristics. Now, what's a levy flight? A levy flight is a random walk in which the step lengths have a probability distribution that is heavy-tailed. Now, what does that mean in plain English? Well, let's say we have a drunken man walking home and he's lost and he's not really sure where he's going, and he tends to wander around from left to right in a fairly random pattern. But this guy also happens to be an Olympic class sprinter, and suddenly he sobers up and he decides he's going to sprint home and he takes off at breakneck speed. That's the levy flight, where it goes from slow random to a really fast move. Now, you often see newbie traders trying to scalp the market for, say, 5 pips. And they're doing that, they're doing quite well, they have lots of winners in a row, and then suddenly the market takes off and moves 50 pips while they're still in their position, and they're wondering what's happened. And that's because the market has gone from the random walk to the levy flight in a moment. Now, I'm going to go through the price action and just explain what's going on in the background that causes that process. So the market's random most of the time, but very importantly for us as traders, it's got pockets of non-randomness. Now, this non-randomness is really important because as traders, that's where the money is. Now, if you watch my Trader's Journey series videos, you'll notice in the video with the dog, I said that if the market was truly a random walk, then we're doomed as traders. It's mathematically impossible to make money in a random walk market because we're paying a spread. So very best case scenario, we're going to lose by the spread cost, and that's the best case scenario in a random walk market. But luckily for us as traders, the markets are pseudo random, and that's where we have an opportunity to make money. So why is the market random most of the time? Well, if you think of what the market's made up of, it's made up of different components. And some of those, for example, would be the bulls versus the bears. So the bulls are buying because they think the price should go up, and the bears are selling because they think the price should go down. You have other people who believe the markets should be trending, and they're playing trend strategies. You have other people who are playing mean reversion strategies. A lot of the hedge funds play those. And then you have a mix of different algo strategies. Some are high frequency trading, some are trend trading algos, some are scalping algos, some are Asian scalpers. Some are using all sorts of different exotic methods. And you also tend to have a lot of nonsense type stuff in the markets like Elliott wave and Gartley patterns and harmonic oscillators. And all of those sort of things come together in a big mash. And the effect of all of these things is really to make the market quite random. One thing balances out another. So what then causes the levy flight, where the market goes from that fairly random action where nobody can make much impression on the price direction to just taking off in a levy flight? And the answer to that is the big players, the really big hedge funds and the really big banks are what caused this process to happen. And I'm going to try and explain that and explain an example of that now. Now, to explain it, I'm going to oversimplify a little bit. So bear with me on this while I sort of explain what may happen on a particular day we see a big levy flight move in the market. Now, there are about 20 big banks active in the forex market, and I've just for illustration purposes listed the top 10 here, and you can see that number 1 is Deutsche Bank with about 15% of the order flow. A further example, let's use a bank trader at Deutsche Bank. So in our hypothetical example, and again, let me say this again please, it's a simplified hypothetical example. IBM comes along to Deutsche Bank and it wants to move some euro back to dollars for whatever purposes, to pay dividends for the quarterly earnings or whatever, and they get a quote from Deutsche Bank. Now the bank trader comes in the morning and he sees this big order on the order book. Let's say it's half a yard. It's pretty small for a bank trader actually. Half a yard is 500 million and a yard is $1 billion, and the price there will have a small cushion for the bank.
So the bank trader has two very important pieces of information there. Number one, he's got the quote, so he knows the price that he can bleed that order into the market at, and he also knows what his cushion is to give him some protection in terms of what he's going to do with that price. So he can use that cushion and the fact he knows when the order is going to go into the market and it's going to start moving the market to push the price around. So let's say he's going to take advantage of that, and he's going to also put on another half a yard as well before he puts the IBM order into the market. So now, just to give you some background, if you take euro dollar is the most liquid currency pairs, and at the liquid times of the day, which typically the London and New York sessions, you can actually get fills on a euro dollar trade ticket up to about $50 million within a pip. The market will eat up that sort of volume, no problem at all. But if you're a bank trader and you want to put, say, a yard or 2 yards into the market, that's a lot of money, and other people will see you coming in with those sort of orders, and that'll start moving the price. Now, how much it moves the price depends on a lot of factors, whether the market's very liquid at that time, what else is happening, is there any news on the market, you know, a whole multitude of factors I'm not going to get into here. But the bottom line is the bank trader needs to get filled at a good price before he lets that big order into the market. So the bank trader can look at the charts and he knows the patterns that dumb money plays. So remember, he's the market maker, so he can put some bids in the market, paint some candles, and run the stops at a good price. Now, typically, euro moves something like 120 to 150 pips a day, but often what you'll see within that is that the euro's trading in a pretty tight range of something like 20 pips or so, but then suddenly it'll take off and cover the 100 pips very fast. And really, that's what's happening during that sort of 20 pip phase. You've got some baking and shaking going on where the big guys are getting filled on their position. So let's look at our simplified hypothetical example here. The current price of euro is 1.38. The bank quotes IBM 1.3760, which is about a 40 pip cushion. Now, I don't know what those numbers are in reality because they're going to vary a lot. It depends on how big the order is, how much they negotiate, what the volatility is at the time, a whole host of reasons. But I'm just picking this 40 pips here just for illustration purposes, so please bear that in mind. So the bank trader then he knows this big order is coming. He knows it's going to mean that the market is going to sell off the euro in response. So he starts looking to get filled before that move gets underway. And he starts putting bids in the market to buy, let's say, 138.20. Now, bear in mind, a lot of retail traders play big round numbers, and they often put their stops pretty tightly around those zones. So they may say put their stops 10 pips or 20 pips above a number like 138. And the bank trader knows this, and then this is why he pushes the market up there, because that's where he's going to get filled on his position. So the bank trader wants to get filled on his own position up there, which is, say, half a yard, 500 million. And he also wants to get filled in preparation for the IBM order up there as well. And then when he's happy with his position size, when he's got what he wanted, then he can let the IBM order rip into the market, and this will start pushing euro dollar lower. And this is where you see the market go from pretty quiet phase to suddenly start making big moves. Now, a lot of retailers are in the market and they're doing crazy things like looking at 1 minute and 5 minute charts. And that's nuts, because most of those charts are noise. The bank trader is typically looking at hourly charts, up to 4-hour charts, up to daily charts. And this is what he's doing and basing his moves on. Now, because the bank trader has a whole yard of inventory to sell at this stage, he also likes to push that price down to another stock-rich, high-volume area where he can get filled. Now, unlike a retail trader who can get filled in one go because his position size is so small, the bank guy has to buy or sell in the zone, and that's why you often see sort of consolidation zones, tight volatility in an hour range, because the bank trader he's selling in bits and pieces, and that's one of the few advantages as a retailer, that you can actually get filled and you can get in and out pretty quickly. So let's say then the levy flight takes our price from the 138 zone down to 137. So the bank guy got filled on most of his position around 138, 138.20, and then when he pushes it down or helps push it down to the 137 zone, he's made an aggregate 120 pips gain, and something's on his own position and something similar on the IBM position. Now, bear in mind, he's only one bank guy, so the price can still go against him. He doesn't necessarily control the market, he just influences it, and he has to watch that some news doesn't come out or that some of the other bank guys don't come in with big orders and start turning the market against him, in which case he has to start selling quickly. Now, luckily, because he's got this IBM order, that helps him soak up the price pressure a little bit over a short time frame, because he can feed that liquidity into the market and help blunt the price moving against him. So this is why you often see sort of fake out, shake outs behaviors in the market, where both stops on both sides of your position, bulls and bears roll and run before the big move happens. It's really the big guys, the big hedge fund guys and big bank guys getting filled before they let the price rip. Now, bear in mind, I'm only giving you one reason here about how the bank guys are playing some of the orders, but other shenanigans also go on in the market. I'm not really going to cover them here, but just to mention one or two. I mean, you can be sure that the big players like Deutsche Bank have got contacts in places like the ECB where they can get an idea of what's coming out. Or in the States, for example, you can be sure Goldman Sachs have friends in high places at the Fed, for example. So they have a pretty good idea of the news coming out often. So let's go in the market now and just look for some live fake out, check out examples that I'm watching as I make this video. Okay, so let me show you an example of what I'm talking about here. This is Euro Yen, and you can see here what the basic training courses teach you is to look for a pattern like this, where you have a sequence of lower highs and lower lows, and you have a trend line beginning to form, and I've drawn that line in here. So then what the bank guys will probably do is they paint some candles. So it looks like you've got your classic resistance point here of a moving average. It looks like the price has bounced off the moving average. You've got a couple of painted candles. Of course, everybody goes short, and they put their stop up here above the moving average line, believing that that's technical protection and that it's protected with that. And of course, you're just a sitting duck there, and then the bank guys or the big hedge fund guys just reverse the price and go up and take you out. So let's have a look at sterling yen as well, because I'm watching this right now and this is setting up in a similar ways. Now it's even better in terms of a trend line here, because 3 points are a trend line is much more powerful than 2. So you've got a very nice sequence of lower highs and lower lows here, well, in classic technical analysis. But you can see here now, after painting these candles, all the stops up there are going to be very vulnerable. And I'm going to be watching this now when the market reopens to see if they're taken, which is what I suspect will happen. So bottom line, if it's too obvious, then you're a sitting duck.
Hi guys, so now if you like the videos, can I ask you just to press the like button, and also please join my Google circle. I will be posting some good live training videos on there, and I think you'll enjoy them, so it's worth your while joining the circle. So thanks for watching.